problem 3 is an interesting and somewhat challenging problem, and I'm going to take it a couple of steps further than what the textbook did, so that I can lecture over some additional material. Anyhow, what I have on the screen right now is the narrative for problem 3. Feel free to turn to your textbook. I think problem 3 is on page 196, 197. But anyhow, here we go. So we're given income from continuing operations. There's an additional transaction, or additional transactions that haven't been considered are as follows. So let's go through and recognize, we needed to recognize what are these special issues. And the other thing that this problem requires is that we recognize, do these special items go on the income statement or on the statement of retained earnings or somewhere else? So let's kind of go through them step by step. The first one says the corporation experienced an uninsured flood loss, and it tells us it's an extraordinary item. So let's just kind of make a note. This is going to be an extraordinary item. And we know, or hopefully you know or recognize, extraordinary items go on the income statement. Number 2, at the beginning of 2012, the company purchased a machine for $54,000. Gives salvage value, useful life. The bookkeeper used straight line depreciation for 2012, 13, 14, but failed to deduct the salvage value. So we have an error, right? The bookkeeper made an error. And so part of that error is going to be in the current period. So we have a current, part of it's current, but these errors that occurred in the prior years are going to be a prior period adjustment. So we have two kinds of errors in number 2. One is current, that will correct the income statement for currently, and the other is a prior period adjustment. Remember, expenses, just like revenues, get close to retained earnings, so these prior period adjustments are going to go on the retained earnings statement. So let's make a little note. That's going to go there. Number 3, sale of securities held as a part of the portfolio resulted in a loss of $57,000. That's an ordinary, just an ordinary loss. And that's going to go on the income statement, and that'll be a part of continuing operations. Number 4, when the president died, the corporation realized $150,000 from an insurance policy. So that's quite common for a corporation to insure one of the major officers. And the cost of that was $46,000. So if we net that, $150 minus this $146, we have a net gain of $104,000. And we'll also need to, when we calculate tax on that, it's non-taxable. So we have an ordinary loss in number 3 and an ordinary gain in number 4. So again, both of those go on the face of the income statement at the top portion of the income statement, or the upper half of the income statement. Number 5, the corporation disposed of a division at a loss of $115,000. Well, that's a discontinued operations. That also goes on the income statement, but it goes above continuing operations. Excuse me, I said that wrong. It goes below continuing operations, so it goes down there at the bottom. And then lastly, number 6, we have a change in the way they're pricing their inventory. They're changing from average cost to FIFO. That's a change in accounting principle. So a change in principle. Get this to right. So a change in accounting principles. So it looks like they've gone from an increase of 60 to a decrease of 20. That's going to be a net overall increase in income for those years of $40,000. So just kind of look at that real quick. The other thing we might notice is that has a tax rate of 40%. Where down here in the narrative, it's going to say the normal tax rate is 30. So a couple things to keep in mind. We're going to have a different rate when we look at the change in principle. Let's go up to number 1. We also have a different tax rate on that as well. So we'll want to keep that in mind when we do the net of tax impact. Okay, well, now that we've gone over that, let's bump down and look at solving through all of this. Okay, so we need to solve for a change. Uh, you know, what is the revised income? So let's see. We started with, in the narrative they gave us, that was $790,000. Okay, so let's put that on our sheet. Number 2. So the items that are going to go here that we identified are really number 2, 3, and 4. So we have correction for prior years. So number 2, so we need to correct depreciation expense. And let's go down here and look at this. Let's see, what they did is they took $54,000 and divided that by 6 years, and they ignored salvage value. So they recorded depreciation expense, right? They recorded their annual depreciation expense to be $9,000. But let's look at what they should have done. What they should have done was take that $54,000 and subtracted salvage of $9,000. Okay, and then that would give them $45,000. Divide that by 6. So the annual depreciation expense should have been $7,500. So we have a difference of $1,500. So they've subtracted, right on, to arrive at net income, they subtracted $9,000, and they should have only subtracted $7,500, right? Expenses decrease income. So they subtracted too much. So to correct this, we'll add the $1,500 back. Okay. All right, number 3. The number 3 item, we have an ordinary loss. So that was the ordinary loss from the sale of securities, and that was $57,000. And then also, number 4 was an ordinary gain. And that was from that life insurance policy on the president. And we're going to net out our original cost on that investment. And we had a net gain of $104,000. Okay, so of all of the 6 items, only 3 of them have an impact on income from continuing operations. So our net income from continuing operations, when I net these 4, is going to be $838,500. So income from continuing operations, just abbreviate that, operations is $838,500. Okay, so we've problem solved for what that will be. So we're going to jump down here, and again, we'll assume then that we're kind of we've already completed the upper portion of the income statement. We just have to assume that's been done, and we're going to do the bottom portion. Okay, so we bring that down, $838,500, and then we have to figure out income tax expense. Well, remember, this $104,000 on the life insurance is a non-taxable gain. So that was the life insurance on the president, and we don't have to pay taxes on that. So we're going to take $838,000. Sorry about that. Let's try this again. $838,500. And subtract out that $104,000. And then in the narrative, it told us their normal tax rate is 30%. Okay, so we'll take their taxable income times 30%, and you should get $220,350. Okay, so income from continuing operations less that, will give us income, net income from continuing operations, 618, 150. Okay. Then also, if you recall, number 5 in the narrative was a discontinued operations. So they had a loss. Number 5, and $115,000. Oh, sorry about that. $115,000. I'm just going to assume you already got that, and I'm not going to go back and rewrite that. So $115,000 loss. And then there's an income tax benefit, so we'll take that times 30%. So 115,000 times 30% gave them some tax savings of 34,500. Okay, then let's net those to a net loss of 80,500. And then last, we have the income before extraordinary item. Recall, number 1 was an extraordinary item, the flood loss, and that extraordinary item, I guess I should write here, loss from disposal. And here, our extraordinary item, we had a major casualty loss. So we had a major casualty loss in number 1. That was for $90,000. And also recall, that had a special tax rate. I pointed that out when we were on that, of 46%. So that particular item, the tax law treats it differently. So it's going to get taxed, has a benefit of 46%. So 46% of 90,000 is 41,400. $41,400. Net that from 90,000, and I get 48,600. And again, that's a loss, so let's put brackets around that number. So 48,600. Okay, so we take income from continuing operations, subtract the 2 net losses, the extraordinary losses and the discontinued operations loss, and we get net income, 489,050. Okay, this problem also asks you to do earnings per share, but I've already demonstrated earnings per share in problem 1, so I'm not going to take the time to do that here. What I do want to do is I want to repeat a little bit about income tax allocation. So let's look at this problem and set up a T account for income tax expense. Okay, and let's look at the items we have here. We want to put this 220, 350 in there, but we've also got these 2 benefits. So let's put those into our account. So 220, 350, and then 34,500 is a benefit, so it's going to go on the other side. Likewise, the 41,400. Okay, so we would have a net expense of $144,450. Okay, and that essentially finishes off what this problem had asked us to do. However, I want us to go a couple of steps further with this. Hang on, I want to go back just a minute. Okay, so we have looked at item 1, 2, 3, 4, and 5. Item 2, correction of depreciation expense. There was a current error, but recall that also went back 2 years, so we're going to have a prior period adjustment. And then also in problem 6, we have something that's going to affect retained earnings as well. So I want to look at those 2 right now. So let's move to that. Okay, so we're going to factor these in. So we're just going to do a what if on this problem. Instead of working an additional exercise, we'll just take the numbers from this problem and save ourselves a little bit of lecture time. Okay, so again, I want to refer, this was from item number 2 in the textbook illustration. So if you recall, in the textbook illustration, let's go back and look at what we did. In the textbook illustration, on depreciation, the company had been recording $9,000 annually, and it should have only been $7,500. So they've been off $1,500. So their depreciation has been, they've overstated their depreciation $1,500. Now remember, that went back to 2012 and 2013, so 2 years. We made the correction for this year in 2014. So we need to go back. Prior years have also overstated depreciation expense by $3,000. And recall, depreciation expense gets closed to retained earnings, right? So that error of $3,000 right now is in the retained earnings account. So theoretically, that $9,000 has been put in retained earnings, and it should have only been, $7,500 and $7,500 in accumulated. So I guess the point I want to make, it's in 2 accounts. It's in this accumulated depreciation account, but it's also in retained earnings, would have been close there. So we need to reduce accumulated depreciation, right, by that $3,000. And we also need to increase retained earnings, right? If we subtracted too much expense, we need to increase earnings for those prior years, and so we need to increase retained earnings for those prior years. Okay, let me say that again. We subtracted too much expense, so it lowered income. So we need to increase income or increase earnings, so increase our retained earnings. So this would be our correcting entry. Okay, so let's post it here for the 3,000. 3,000 would go in accumulated. And so then now we would have a correct beginning balance for 2014. And then of course they would have already recorded the 9, if you recall. They recorded 9 again in 2014, but we corrected that in the earlier part of this problem with 1,500, which would net that right to 9,000 minus 1,500, net it to your 7,500. But anyhow, we've got the correct beginning balance. Oh, sorry, I see I have that written down here. I could have put it in there. Okay, so we've got an adjustment to retained earnings for $3,000. Okay, let's move on to number 6. Number 6 is a change in accounting principle. So it told us and again, that's going to impact 2012 and 2013. And it told us the net impact on earnings, or net income, we netted that to $40,000 in that narrative. So they changed from average inventory costing method to FIFO, inventory costing method. And that would increase earnings, so it's going to increase retained earnings. You've got to have to think, well, what's the other side? Here's our, let's see if I can erase that without it going over everywhere. Okay, so we've got assets plus liabilities and stockholders' equity. If we know it's increasing stockholders' equity via retained earnings, so we know retained earnings is going to go up, what else is impacted? Well, this is costing inventory. So we've also got to increase our inventory account, $40,000. So retained earnings goes up on one side of the balance sheet, inventory on the other. So here's our correcting entry. So we would debit inventory $40,000, and we would credit retained earnings to increase each of those for this change in accounting principle. Okay, so let's take these two things. These are restating beginning retained earnings, 3,000 and 4,000. So let's go to the next sheet. The problem didn't tell us the beginning retained earnings. I just made this up of $5 million. There are two things that can adjust our beginning retained earnings. One is error correction, those prior period adjustments. So here we have a prior period adjustment for the depreciation. Remember, that was $3,000, and that was going to increase retained earnings. But we also have to convey, well, what would be the tax impact? So prior period adjustments and this change in accounting principle are also going to be net of tax. Recall the tax rate is 30%, so 3,000 times 30% gives us a net tax benefit of $900, so the net cost is $2,100. The change in accounting principle, we said that would increase retained earnings $40,000. Again, we're going to do our 30% tax impact, so we get a net. We might actually, on both of these, we probably get a tax refund of $900 and $12,000. We go back and amend those tax returns. Okay, so we have a net change of $28,000. Okay, so $5 million, factor in those two. We're going to restate our beginning retained earnings to $5 million, 30,100. Okay, so now we can have our beginning retained earnings, 5,030,100. Let's go back and take a peek, see what did we have? All right, for retained earnings, so we're going to take this ending retained earnings off of our income statement, move that forward to retained earnings. So 489,050. There were no dividends, we don't have anything to subtract, and we'll have an ending retained earnings of 5,519,150. Okay? All right, so there's the retained earnings statement, and we've known all along, beginning retained earnings plus net income minus dividends gives us ending, but all of this up at the top is new. So if something happens in prior years and we need to go back and restate, we take that, that's going to, the account where revenues and expenses and gains and losses get close to is retained earnings, so we take it there. Last thing I want to cover, and then we'll be finished, is that these two have income tax impacts. That's also going to, when we would have actually made a journal entry for that, but I'm not going to do the formal entry. But let's go and look at we'll see that in later chapters, by the way, but let's go back and look at, well, how does that affect net income tax expense? So remember the $900 and the $12,000, we'll go put that in. So back over here, we had two benefits, $900 and $12,000. Right, those were tax benefits, so they're going to go on the decrease side. So we had $144,450, net those two, and we get a net tax expense of, hang on a minute, I said that wrong, didn't I? Sorry about that. Let's go back. I very much said that wrong. This is an income tax expense of $900 because we have a gain, two gains. So we have income tax expense of $900, income tax expense of $12,000. I'm sorry, I said that wrong because this is a gain and that is a gain. So those both increased earnings. They increased earnings. I'm sorry, I did mistake that earlier. We're not getting a refund, are we? We're actually going to have to pay extra taxes on that because our income went up. In both cases, we have to pay additional tax. So if you were wondering whether my reasoning, you're right, you caught me. I misstated there. Okay, so let's move those over. 900 and 12,000. Okay, and so the bottom line, we have $157,350. So our net tax expense would have gone up $157,350. All right? Okay, and so I'm not going to demonstrate exercise 14 because it gets into the prior period adjustment and that sort of thing, and I think you'll be able to work that one on your own. The last thing I want to talk about is then a change in estimate, because we've looked at a change in accounting principle. Another common change in accounting is just changing an estimate. So let's take, what we've been looking at. Remember this company had a machine, $54,000, and that they had been incorrectly recording the depreciation. But in this what if, I'm going to assume that they don't have any errors. Let me change my color here. So let's assume that they have been putting $7,500 in the account for accumulated depreciation. So they would accurately have $15,000 in accumulated depreciation at the beginning of 2004. So instead of changing the method, which is a change in accounting principle, so instead of changing their changing an error correction, they're just changing their estimate. So what if they estimate they're going to use it 9 years instead of 6? This is not an accounting error, by the way, if at the beginning when they bought this machine it was reasonable to anticipate they would only use it 6 years. Remember, that doesn't mean how long the asset or the equipment can actually exist in this world. It's just how long the company anticipates using it. So they really only intended to use it 6 years, but now they've changed their mind and they think they're going to use it another 7. For a total of 9. So they're really bumping up. They've already used it 2 years. So really we've got an additional 7 years left in this machine. So what do we do? Well, there's no formal journal entry for this change. We're just going to go back and create depreciation like we always have. So we're going to take cost, subtract out our salvage. Hang on a minute. Let's subtract out accumulated depreciation at this point, so that we can have an idea of how much of the cost have we not depreciated yet. So we have a $39,000 accounting value. Recall that's called book value. So the accounting records used to be books, so we have an old term, book value. So the accounting value is book value of $39,000. Now let's subtract out our salvage. So they think at the end of the 9 years they can salvage it for $9,000. So we have $30,000 of cost that has not been depreciated. So this needs to be depreciated. We've got 7 years left, so just divide that by 7. And we have $4,286 is now our new annual depreciation. So recall this is at the beginning of 2014. Here at the end, we're going to make a journal entry for $4,286. So there's no impact on prior earnings. No impact on prior earnings here, so nothing to do to the retained earnings.